Welcome to the Mortgage Broker Podcast, tailor-made for Canadian mortgage industry professionals. Proudly presented by a Better Way Mortgage Group, this podcast is your trusted source for insider insights, market updates, and strategies to elevate your career in the ever-evolving world of mortgage brokering. Whether you're a seasoned broker with a Better Way Mortgage Group or an industry enthusiast looking to stay ahead, our episodes are designed to empower you with the knowledge and tools you need to excel in the Canadian mortgage space. We're back for another episode of the Mortgage Broker Podcast, and today we're continuing on with the Behind the Lender series, and we're fortunate enough to have Mike Forshee, who is the president of Glasslake Funding and managing director of Bayview Asset Management, which is a parent company to Glasslake. We're really excited to get into this one. Glasslake has emerged as a real big player within our brokerage and the industry as a whole in Canada. Definitely providing some alternative solutions that have certainly found a need in our market. So really looking forward to getting into everything to do with Glasslake, but maybe we can just start with a brief introduction to yourself and kind of your story and how do you found your way here to Glasslake.
Yeah, well, first of all, thanks for having me, guys. Big fan of the show, so
Awesome.
I'm glad to be on it.
Thank you.
Like a lot of people in the industry, I ended up in mortgages completely by accident. My older brother was playing professional hockey in England, actually, and I didn't know what I wanted to do, so he said, just come over and bum around for 6 months, and I ended up getting hired on as one of 30 entry-level mortgage advisors at Nationwide Building Society. So I stayed in the UK for a couple of years, came back to Canada, worked at ING for a cup of coffee, then moved on to a startup called CLN Highlander. Eddie Cocciolo, who you had on last week,
yeah.
he was our sales guy at
wow.
CLN. And then I moved on to CIBC, Home Loans Canada, and then eventually Home Trust in 2004 and spent 18 years at Home Trust before leaving in 2022 to join Bayview and start Glasslake.
Wow, I didn't know that about you. That's a interesting background. Like our paths connected when you were at Home Trust, and maybe we can kind of just start there, like your role at Home Trust and how it fueled you or gave you the experience that you needed to start Glasslake.
Yeah, well, when I moved over to Home from Home Loans Canada, I started as an underwriter. I was still pretty young. I think I was 25, 26 at the time. That time, I think we had 80 employees, maybe $2 billion under management, and so it was a good time to get into the company because it was just starting kind of the growth trajectory. So you got to experience everything, right? So you were doing underwriting, admin, fulfillment, collections. So you got to see the full front and back end of the business. And just as the company started growing, my kind of career grew with it. So I was given the opportunity to run what we called a zero team, the first ever zero team, which was a bunch of brokers that never funded a deal with Home Trust or did and had a bad experience and never came back. So a lot of the older vets didn't want that job, so I decided to just jump in and take it and see where it went. We funded $80,000 the first month of operation. I took a lot of crap for that in the management meeting, but we eventually grew that to fund over $1 billion a year, so we were quite proud of it and started spinning off sub-teams with it. And then from there I ended up becoming what they called a group leader, so a bunch of teams reporting into me. And then I took over Western Canada, and a year into that, I moved out here, which was supposed to be for 6 months, turned out to be 5 years, and ended up moving back to Toronto in 2016.
You said you started at Home Trust in 2004?
2004.
So you saw the 2008 crisis. You also saw the Home Trust almost collapse. You kind of lived through all that?
Yeah, like those are two. I always say, like, you can't pay for that education.
Okay,
sure.
Right? Like it's something you don't want, like, especially the 2016 run on the bank.
Yeah.
It's definitely something you don't ever want to experience, or maybe just once. So you now know what to do, what not to do to get yourself in that situation. 08 wasn't too bad for us. I think we got a little, like everyone, we were a little nervous when everything started breaking, but we actually turned it into an opportunity. We started. That's when we started the accelerator insured business. We were buying portfolios of some of the other lenders that were having trouble. So that turned out okay. Obviously, the situation in 2016 was different. That was a choppy one.
The only reason I brought that up is, I mean, the experience and knowledge that comes from that. I mean, I know Glasslake isn't super old. You guys launched in 2022, right?
Yeah.
Like the experience that you gained and all that obviously would drastically be supporting the business that you're now operating, right? I think there's a lot of people that get into the alternative space and they don't really understand how nuanced it can really be, right? And how dangerous it can be at the same time. I mean, everyone, pick 10 brokers, 5 of them have plans of starting a MIC, or they have started a MIC, right? But we know there's a lot of them that are fairly challenged right now.
Look, I saw a huge opportunity after seeing what happened, in the alternative segment over 20 years, both inside at Home Trust, but also look at the success Equitable had and a few others. But with the regulatory changes, which actually started in 2012, we started feeling it in 2012, and they just got deeper like every couple of years. You could clearly see just in what you were booking inside the walls of Home Trust and what the fallout was and that opportunity in the private space. So when I first got the call from Bayview, I was unsure. An American company coming into Canada, but they were so well researched, and it reminded me, such an entrepreneurial mindset inside the parent company. It reminded me of the early days of Home Trust. So I thought it was just a fit from a culture perspective, but also just the opportunity in front of us. And I think you're right. Like we started the business. Not many people know this, just wanting to be behind the scenes and funding other lenders, but we quickly realized that we weren't going to be able to scale at the same rate as if we did it ourselves. So we went out and hired a team. That's when we branded Glasslake. Right. And we got off to a choppy start. Like, interest rates were just rising. Like everyone was unsure of values. So we made a disciplined decision to launch just at 65% loan to value with 3 and 5 year money only, which was unheard of for years in the alt space, right? Everyone wants rehabilitate the client.
Yeah.
But there was 2 things. We had to build a portfolio. So it's tough to build a portfolio on 6-month and 1-year terms as they keep rolling off. But 2, I wanted to give confidence to the parent company that we were running a responsible ship, build it to a certain level. I think it was 6 months in, we ended up moving the LTVs to 70 and then 75, and now we have 80 on the shelf. So looking back, we had some tough moments, but I think we're quite proud of what we built and how we built it. And, the performance of the portfolio has been pretty solid. But we are noticing, when people sell us portfolios, like you mentioned, a lot of new mix popping up. There's situations where you even ask for the guidelines and they're like, oh yeah, we'll get you the guidelines. And a month later, you still don't have the guidelines, right? So you're like, okay, you're making up the guidelines as you go here. Like, okay, so, and that just doesn't fit for us. Like we pride ourselves, like, we touched on the 2016, 2017 issue at Home Trust. If anything, we built, we're not a federally regulated institution, but we've built a business with the governance and controls of a federally regulated entity.
Right.
I mean, one of the things that, going back to my early, years of my career, Home Trust was a very easy, common sense lender to work with. I mean, things obviously changed with regulation, some of the issues that occurred. I get like an early days home vibe from dealing with Glasslake. Is that, maybe just touch on kind of your mission with Glasslake and what you're looking to achieve. And am I on the right path in thinking that, early days home is kind of the vibe of what you're going for to a degree?
Yeah, to a degree. I think, look, times have just changed in general, I think.
Yes.
So, but look, the big difference is, when I started at home in 2004, we had 2 or 3 billion under management. We're starting this Glasslake from 0.
Yeah.
So again, you have to, like, the critical points to get to are like the first billion and then kind of level set and see where you're going. But I think, the mindset's the same, right? Because it's entrepreneurial. Yeah, we have some guidelines that we don't veer off of, just because when you look at the data, it doesn't make sense to veer off of them. And when we look at the market opportunity, so some things people want us to put on the shelves just doesn't make sense to us. We were at, I think it was the MPC conference a few weeks ago, a month ago, the Vancouver one, and we kept getting asked for second mortgages, and I see there's a need for seconds.
Yeah.
But we run a pretty lean ship building a portfolio. Like, why would we put capacity on second mortgages that again may run off pretty quickly? So, there's good second mortgage products. There's lenders that are great at seconds. That's just not a thing that we're going to put on the shelf right now while we're building the portfolio. We also have minimum FICOs. We're pretty disciplined on the FICOs because you can see the performance, the data tied to the performance, that once you get below the 650 FICO, like performance drastically changes. And then once you get below 600, it changes again. So again, in building a business, we wanted to make sure we were, building a performing book. And, but the mindset's the same. Like, we have a phrase we use internally called up. Alex Godfrey, our head of credit, came up with that. It's underwriters pick up phones, right? So, which
I like that.
Which is an important piece of the business, right? Like in the alternative world, sometimes you can't get to solving the income challenge via non-traditional income on an email.
Yeah.
You know what I mean?
Yeah.
You have to be able to get on the phone, talk about it, and understand it a bit more.
Oh, 100%. Because there always is a story, right? Like we were just talking before we kind of went on air here, just like, the types of borrowers that are looking for these larger loans with bigger interest fees and whatnot, like that has to make sense for, what they have going on in their life aside from, income and how they're going to service it. Like, what does this make sense ultimately, right? Like that up, I like that a lot. And that just kind of drives into your value proposition. Very much a human-centered approach in that sense. Even just the fact that you're picking up the phone and like just where the industry's gone and is continuing to go to is it's so behind emails, so behind the keyboard. Like maybe we can just touch on like the value prop as a whole with Glasslake and what the focus is there.
Yeah, like I think it's just that. Like, look, we think we're fairly good, not perfect, but we're fairly good at managing our broker accounts and building relationships, and then putting the product around it. The product that no stress test, 40-year AM, self-employed income, 6 months bank statements, all the stuff that really makes it a non B20 deal. No sliding scale, bigger ticket loans. So I think as a whole, we put something together that services a large part of the industry. We do kind of see it though as the missing middle or the new middle, where you have the large alternative lenders, and then if the deal can't get done there, traditionally it was going into the private mix space. Well, we're kind of the stop off in between, we feel. So as you're going down, like you're stopping here, hopefully going back up. And then as you graduate out of private mix world, it's harder to get to the large alternative space or the B20 space. So you need a landing spot for a couple years as well. Yeah. And I think, I mentioned this briefly, but when we launched, we got crapped on because we only had 3 and 5 year terms, right? Yeah, that was probably a bit too much. Now we have 1 through 5 or 1 through 7 actually, but there was an article that came out in the Globe and Mail just after we launched where certain lenders weren't renewing, and then we saw the traction where people started wanting 3-year money, and we also pulled some data that showed, I forget what the number was now, but the average client in private land was refinancing 3 times in private land before getting out. So think about the fees. We talked about the fees before we got on air, paying new commitment fees, appraisal fees, legal fees every year, where, we can offer for the client that just needs to, settle taxes and then move back up. Okay, yeah, that's probably a 6-month, 1-year term. For someone who's dealing with a 65 TDS, working as a plumber, and doesn't really see, like they can still manage, you can see that they can manage their bills, but you just can't see the path back up, like to the B20 lenders. So
and for some borrowers, like they may live in one of these products for the remainder of their financial lives, like carrying a mortgage. Like is that looked at, like when we look at current trends and insights, like a borrower that's maybe self-employed, trying to, keep their income down from a tax perspective, have all these other reasons why, maybe they might just never get back to a Scotia or a TD. Like, how do you feel about that? And like, is that a trend you're seeing? And are there any other trends that you're seeing that are, sticking out to you?
Well, yeah, like I think first and foremost, we're going through, because we're still fairly new, our first renewal cycle. And the renewal rates are a lot higher than we anticipated, which is fine. That's good. And we'll take them. But I think that goes to show that options are limited. We're providing good service, decent pricing, not the best, but not the worst. So the client just gets comfortable, being, and we're institutional too. We're not we're not Jimmy's Mortgage. Like we have balance sheet funding from our life co. So people, as they learn the Glasslake Bayview story, get more comfortable. But yeah, I would say renewal rates have been the trend that is kind of shocking to us. Well, maybe not shocking, but surprising to us, where we were kind of banking on a 50% renewal rate, and it's at 80 now.
Wow.
Small numbers.
Yeah.
Again, we're just going through our first renewal cycle, but and we only have a limited amount of 1 years because we offer all the various terms. But that wasn't something we were expecting.
Even more interesting on that note, because like in the last year, rates have come down, right? Conventional and alt. So you think it'd actually be easier for them to get out of a product like yours now, and it's still at 80%.
Yeah. I would agree with that statement. I would have thought it would have, with rates coming, we got worried. We were worried because as rates came down, we thought the runoff pre-renewal was going to happen. Yeah. People were going to start jumping in. We just didn't see that. Which signals to me, and I don't pretend to know what goes inside of like all the other institutions, it's just getting tougher to qualify. It's still tougher to qualify, right? And that creates opportunities for us at Glasslake and some of the newer entrants.
I mean, it's like we've talked about this a lot. Like just looking at our E&O policy as an example with our brokerage. Going through those applications every year, you have to look back at like, hey, what is your mix of alternative, private, prime? And, we saw an increase from alternative private from 22% in 2023 to just over 34% of the entire brokerage volume, alternative private, just in 2023 to 2024. And then again, we're seeing like that continue to increase in 2025. And, all the private lenders, alternative lenders that we talk to on a regular basis are only seeing more and more, push to that market. With that's obviously, why, there's an opportunity here, and there's more opportunity even from the fall off from your book when you look at like second mortgages and mix and whatnot. Is there any, like maybe just looking at the borrower resilience in Canada, like you have these renewals coming up. It's a surprising amount, but what is the default rate look like the arrears? Like are you seeing the same borrower resilience that like, the rest of the nation is essentially seeing? Yeah.
I would say we're quite happy with the performance. We had one misrepresented deal that caused us some challenge that we've just worked ourselves out of. And there's been a couple, is there arrears on the books? Yeah. But are we comfortable with the level? Yeah, I'd say we're outperforming where we thought the portfolio would be performing at.
Yeah.
So yeah, it's resilience. And what we're finding now too, and I don't know if I'm just noticing it more now because like we're in a smaller institution than where I came from, but more clients, if they're going to miss a payment, are calling it ahead of time and saying, hey, I can't make my payment on the 1st, but I'll pay it on the 5th. And I like, that just shows like the consumer behavior in Canada, which I think is pretty impressive.
Totally. Okay, I wouldn't mind getting into some of the behind the scenes operations now and just looking at like the team structure and workflow. Maybe you can kind of describe a typical day for like a Glasslake underwriter, credit adjudicator, and just focusing on like your collaborative approach with brokers and how you streamline deal processing.
Yeah, so we from an underwriting perspective, we timestamp everything. So the underwriters are kind of judged, or their performance scorecard is based on time to get deals out the door and quick response to brokers. So, each day is different. Being a newer entity, like some days we're getting crushed with deals, some days there's a much lighter flow, but it's the underwriter's job to move the deal as quickly as they can out the door with the right structure, right? So they spend a lot of time structuring the deal with the broker. Just on that note, like a side note to that, one thing that is slowing us down right now, and I think some other lenders have noted this when I talk to them, we're seeing the same deal multiple times a week.
Right? So from multiple brokers.
From multiple brokers.
Interesting.
And what makes it one level, I was on a panel last week and we were talking about this.
Different information every time, I assume
completely.
too, right?
Yeah. And so, And it's not like it's like one was a plumber and the other one owns a variety store. No, they're all plumbers, but like the income is just completely different on each one. Um, so so that's slowing us down a bit. But I do think, yeah, when the deal comes in, it's just immediately connecting with the broker to structure the deal that works for everybody, and then just keep moving it along. Like we try not to over process our process, because you could have all these different jump off points with 2 or 3 people touching the file. We prefer the underwriter to take it kind of cradle to grave, just so the consistency is there on.
It's far more efficient too, right? Yeah. And that kind of digs into the next question, actually. So, it's interesting for us because we brokered for a long time, and seeing every lender and how they deal with escalations. And some people are very poor with it and they take a long time, and others are quick and they action. And a quick no is always a benefit to a broker, right? What is the process inside of Glasslake for escalations?
Yeah, it's a one-step process. So the underwriter just, again, this is part of this is the good part about being small and lean. It's just the underwriter to the head of credit, and then the decision's made. There may be a little back and forth. I think, sometimes we do struggle, especially on the bigger ticket deals, and getting enough information to actually get comfortable with it. Like it's, I gave this example a while ago too. We had a $4.5 million deal where the mortgage payment's 27 grand a month, but the client's only makes 14 grand a month. So how does that even work, right? But you can look at the application and say, this info's wrong. Right, like he has an 800 FICO, carrying a $4 million loan already. Yeah, it's impossible that these are the numbers. So let's go back and figure it out, or get the client on the horn with us, and we'll figure it out. But so I think we're really great at structuring deals, and that's how kind of when we hire underwriters, we put them through the paces of, okay, what would you do in this situation? Like give them case studies, because it's not just data point lending where it's like, oh, this TDS, this FICO, good to go. You have to really understand the story and why they're here.
So you guys would actually jump on a call with the borrower.
And the broker. We wouldn't do it with the broker.
Yeah, for sure.
If we leave that up to the broker, but we do offer that as a
that's cool.
service.
Yeah, that's super helpful. I mean, maybe that just kind of goes into like highlighting some of your decision making processes, and like you're not just an equity lender. I mean, you're far more than that. More institutional focused. Like, what are some of the factors that you're looking at? Like, obviously there's client financial stability and property viability. Like, what goes through that process, and what do you prioritize?
Yeah, property's always first. Yeah. Property's king. We have a wider geography net than I think a lot of alternative lenders do. And people say, oh, why are you going into secondary or tertiary markets? Well, to me, there's good areas and bad areas in every kind of town or city in Canada, right? So we spent a lot of time while we were building the business kind of figuring out core areas in the secondary market of where we would lend and where we wouldn't, have local people on the ground there that can do site inspections for us if needed. But at the end of the day, when looking at property, our view is pride of ownership is a better view into how the client's going to pay than even the credit score.
Yeah, interesting.
Right?
Yeah.
Right. If someone's taking care of their house, it's upkept, it's tidy when the appraiser goes in, they're gonna treat that's their house, right? So they're gonna pay the bills. If it's smells like dog urine, and those are usually the ones that give. It doesn't matter if FICO; those are usually the ones that give you some problems.
That always made my head spin when we'd see appraisals like that. Like, who doesn't clean up their house a little bit before the appraisers come
completely.
in?
We saw one appraisal a few weeks ago. Someone was still in bed. I didn't even think they were allowed to take a picture of it anymore. But we're like, is that a foot? But we go property first, and then the second piece we look at is how often have they dipped into the equity?
Yeah.
Right. We're coming out of the largest run-up in home values in Canadian history. How many people were just dipping into the equity to just keep the mortgage afloat, and are they going to hit a wall? So we often question when we see, or one or two refinances in the last 12 months, or maybe we'll pump the brakes on that one to figure out a little more. And then we go into the traditional, what's the FICO? Where's the income? How long have they been in business? Like that's a big one. Like I think you guys would know this better than I, but sometimes I think some brokers get really lazy with that and just put like the 3-year mark in to, get it so you can send the application. It would just be go a little deeper. There's much different of like someone who's self-employed for 3 years versus 20 years, and they can demonstrate the sustainability. So that's really the process in a nutshell. We price it with the broker. Broker gets a call. We want broker's input on pricing, fee, so you can you guys. Your brokers will know the client better than we will. What are they more sensitive to?
Yeah.
And then put a final structuring to it.
Cool.
Hey everyone, Dean here. Quick timeout from the episode to share with you the ABW Tuesday Mortgage Memo, your weekly market highlights sent directly to your inbox every Tuesday. This is certainly one you're not going to want to miss, so make sure to sign up now. You can do so with a link in the show notes, or you can head to joinabw.ca and sign up there. This is a high-level summary of market developments, regulatory updates, and housing trends every Tuesday. So hope you enjoy it, and back to the show.
There's a lot of gray area, obviously, in lending in general and finance in general. But especially when you get into this kind of alt private type market, there's a lot of gray, and there's a lot of, especially because it's unconventional. How do you guys deal with these gray area type situations that come up, and what is the process, and how often are you bending on your typical guidelines?
I would say, that's a great question. I would say we're in the gray a lot.
Yeah.
We're in the gray a lot. But it comes back to what Dean said earlier, right? It's really just trying to understand, the self-employed individual who doesn't want to, who isn't going to claim their, full income or whatever it may be to the CRA, or they have the right to write it down. And looking at the trade-off, does that actually make sense in these situations, right? Does it make sense to have 50 grand worth of income and pay a 5.5 handle on the rate versus 75 at a whatever you can get a prime mortgage for today? So and we just want to see people again who just show that they can make payments, right? They are resilient. We know that the data shows it. But what we don't know is how much of that resiliency was actually resiliency, or just home prices saving everybody.
Yeah, fair.
I shouldn't say everybody, but
yeah. So moving into maybe some of the technology and innovation, maybe you can discuss some of the tools that you've implemented with Glasslake, maybe things that you're looking at in the future that can help Glasslake be more efficient, but also brokers be more efficient and enjoy the experience.
Yeah, we're working on 2 key initiatives at the moment. One is, let me step back for a second. I don't believe in huge technology improvements. I like what I call micro innovations. I've seen a lot of large scale technology projects that they were great and they were fun, kind of, but they may not have produced the what you thought it was going to produce. Yeah. So I think, especially in the alternative space, it's that healthy balance between what technology can you implement that makes the underwriter or the salesperson more efficient, but doesn't take away the being able to operate in the gray or understand the story.
The human element.
Yeah, because you can get, we have a bit of a different view. You mentioned earlier quick no's, right? Mm-hmm. We're kind of how do we turn more no's into yeses?
Yeah.
Right. So where if you're going really quick and you have some technology behind you, maybe it filters stuff out, but maybe there's an additional capture rate of 10 or 15% that you're missing out on. So one of the things we're looking to implement is automatically pulling the bank statements, right? Because in all the data we've been collecting, we could take the cash flows from the bank statements, because we don't go right to income, it's cash flow. And use it, I don't want to give too much away, but use it internally in a model with the FICO and some other elements to spit out on maybe 15-20% of the apps that come through the door auto approvals, right? Because they're just, right? And then you have that next subset that need to be kind of a yellow, that need the story in the underwriter's hands. And then you'll have a few that are just red for whatever reason. But so... we're looking to get that implemented by the end of the year. It was actually a little bit more of a larger project than we thought, and there's some broker change with that too, right? Because not all brokers we talk to want to go down that route of just sending the client a link, giving the bank statements. So we're trying to find that healthy balance.
That's a good. I mean, I'm glad you brought that up, because we've been talking about that a lot, like from a velocity perspective, like the ability to go through. I believe it's Flink's software that they plug into to pull those statements. Like, it can make the broker's life a lot easier earlier on in their adjudication process of how they're trying to figure out where does this person qualify.
Yeah.
It's a far better experience for the client too, opposed to sending in all these bank statements and so on and so forth. Like, where do you think like it's going to change the borrower, like I guess I don't know what the right word is for this, but like where is it, or is a borrower going to find trust to actually do that?
Well, I don't know. I don't think that's been proven out yet. Yeah. But there are other companies, in non-mortgage lending that have gone that route, and the adoption's there, because it has to be, or you don't get what you're looking for. But I do think as well, outside of just pure efficiency and getting quicker approvals and quicker solidified approvals, right? Because if you get that early stage, you're good. Like you're good to go. But I think too, like we get nervous. We get very nervous when we have a deal and it's a purchase, and the commitment's been out for 2 or 3 weeks. We have the sign back on the commitment, but we don't have the bank statements yet. Why don't we have the bank statements? Yeah. Right? So like, you're closing on $1 million house, $1.5 million. You're 2 days away from closing, but we still don't have the bank statements. So
that's a red flag for sure.
Yeah. And then when those come in the day before scheduled closing, you end up going deeper on them, because you're like, why did this take so long? Yeah. Now, sometimes, maybe the client was away, the broker had 20 files going on, so they forgot about us on this one or something. I'm not saying they're all fraud when they come in, 2 days before closing, but definitely a red flag that you're going to go deeper on. And you think, okay, they're just trying to shove it in at the last second.
Well, I mean, that's just an example of just a chaotic way to run your business as a broker, right? And, preparing the client to submit those bank statements should be done before submitting the file to the lender, for so many reasons, right? And then that just creates a frustration for the broker. There's always a blame game being played from client, broker, lender, what have you. But it's just back to just general preparation, right?
Yeah, and I mean, I like the direct bank statement access piece too, because there is no excuse, right? Like, if people are delaying because they're out of the country or what have you, it's like there's no excuse to not provide these if you have that option for them. So talking a little bit about deal priority or lender priority, if you want to call it that, pretty well all of our listeners are mortgage brokers. I always like to ask this question, if there's, and we know how it is, relationships are important, right? But if you guys have, 30 applications in your queue, I know there's a prioritization as to when they came in, but what are some brokers doing that would kind of push Glasslake to grab their file first?
Notes. Like the note, like just notes. Like, I'm not even saying good notes. Just put a few notes in there. That'd be helpful. Like, I always joke about this. We get, many deals a week where it's like, refi to 80, bro. And you're like, okay, what are we going to do with that? Right. So, especially on like these gray area files, like you need to be walked to the water. Like, you got to help us understand where we're going.
That's quite the answer. I wasn't expecting.
Yeah. So it's like, we do have a priority queue, because we've launched what we call our Wave Makers program, which is our top funding brokers. And then you get priority queue. Right. But outside of that, if you just have notes, and just tell us what's going on. So we can get started and get into it, right? If it's just refi to 80, bro, we're going to be calling you down all day to try to like get the story before we even do like some of the work, because we don't know which way to go with it.
Totally.
We always trained our team when we were running our book of business. We always trained our underwriters. Like, the goal is to submit a deal so we can get an approval, and there's no communication needed, right? Like, take the extra 10 minutes, 15 minutes, even if you can't submit the deal for an extra day because you got to go to the client first. Like, you absolutely need to be doing that. I just think of myself as a broker. Like, there's only so many, there's 60 lenders in the country that you can work with, but you only really work with like 10, right? And if you're going to continue to abuse those relationships, like they're just not going to pick up your files, right? And things are going to take longer and you're not going to get good service. Like just put the extra effort in. And it's crazy how much better your business will flow, right? Like the efficiency just skyrockets.
Yeah, maybe this shouldn't have been shocking, but like we've had to cut off a number of brokers. And not really many due to like misrepresentation, but just clogging up the pipeline, right? Sending 10 deals, not closing any. You got to go.
Yeah.
Like, I learned in my past life, we decided, I think it was in 2020 or 2019 to remove 5,000 brokers from our broker list. And everyone was freaking out, right? Like, I'm not sure if we should do this. And we ended up just ripping off the Band-Aid, and some brokers were pissed, but man, the efficiency just sped up. Like these were all people that were just throwing deals in, not able to close them. So it was taking away time, energy, and effort from the brokers who were our top supporters. And we see that here too. So just understanding it, I think, look, we know where we play. Okay? We're not a prime lender. Yeah. So don't be afraid to tell us the good, bad, and the ugly, because that's what we're here for. If we don't know the bad and the ugly, like chances are we're not going to structure a deal that makes sense for the client.
For sure.
Going into, like you mentioned, efficiency, when we look at our prime lenders, our alternative lenders, Equitables, Community Trust, all these, the main players, efficiency rating is such a key component to what they're focused on. Are you there yet? Are you starting to look at efficiency, and do you think you will, look at that deeper going forward?
Yeah, we'll definitely look at it deeper going forward. I think we just made an investment in a data scientist. Now we have a bunch within the Bayview family, but in a Canadian data scientist who has experience building probability models, et cetera. So you get a probability of funding. So that's another core investment we wanted to make, so we can, because like efficiency to me, like it's a great word, right? Like I think sometimes it's overused. It's similar to the common sense phrase, right? Like people are like, it's common sense lending, and so like what is efficiency, right? Is it just quick turnaround time, being able to fund on time? If that's the case, I would say I'd give ourselves maybe a B- at the moment.
Okay.
On our way to like a B+, but that's just because we can't, like, we're still getting some of the pipeline clogging because of like time wasters. Right. So I think we're on our way there. I think some of the micro innovations will help further. We've just brought on 5 new people starting this week, actually, or 3 new people, and then 2 more to follow. So we're putting a lot of investment into the business now that we know we're an actual going concern, right? Like we've gotten over the startup hump. We're now in the fun, like, okay, we're getting to a significant balance under management. Let's prepare for the next stage, and how do we get there? And we can't get to that next stage if we're not, speedy with the brokers.
That's got to be a good
solving
feeling.
Problems.
Yeah.
Yeah, it's a much better feeling today than it was. It's sometimes when you're starting the business, you're like, oh, are we doing the right thing? Or, you always want more business to come through the door. But there were certain times it was fun but tough. I don't know, building the business, and now we're reaping some of the rewards, so it's good.
Very cool. Let's jump into some of the broker lender dynamics, mainly around communication and support. We talked about, just your preference for direct communication channels, picking up the phone, the underwriters actually speaking to the agent on the other side. You also, you have some really good people within Glasslake. I mean, we know Jake Bannister well, who is our, direct account manager. Like, what is the focus there when it comes to communication support and just having the right people and anything you can share on that landscape?
Well, I think the right people is key. So what's right for our business? Entrepreneurial mindset, like to actually work, like dealing with brokers, because look, it's a tough job, right? It's tough on both ends, right? Yeah. But it's a tough job, and you got to find people who truly like doing it, right? And I think we built out a pretty respectable team of people who have deep alternative experience, so they know where the pain points are. They've seen some of the toughest deals around, and our funding matches that, right? Like I think sometimes you get alternative shops that don't have alternative funding, and then it doesn't matter what you do, like there's always going to be a mismatch in the approach and the business objective. So I think we've done a nice job of kind of matching our talent with, with the funding and with the business plan of what we came in to do. And I think we're, we don't actively recruit. People have been calling us, which is a good feeling as well.
Absolutely.
So we don't send people out banging on doors. We've really just people come to us because they think we're doing something decent, and that's exciting as well.
Is there something specific that you look for in like the account manager role, like the BDM role? Is there something specific, like when I think of the people that we've worked with that are really good at their job, is reaching out on the phone and getting in front of agents to just start to create those relationships and get the deals flowing in the door. Building that trust is where we see the BDMs that we work with excel.
Yeah.
And without saying this too negatively, there's not very many good ones that are even willing to pick up the phone and outbound, let alone pick up the inbound, right? So again, that's just a very, elementary level barrier, but what is there anything in particular that you're looking for?
Well, you talk about client resilience, just employee resilience.
Yeah.
Again, it's a tough job. And when you guys are calling them down, they need to respond and do it well and get involved. So I think, I tell that you mentioned Jake, right?
Yeah.
So I knew Jake before. Jake did some time at Home Trust when I was there. Then he went off and I think he was selling cybersecurity software, which is a tough job, right? That's a tough job.
Yeah.
So, we hired Jake was our first sales guy, and he's shown that resilience. Literally, I was driving the Whistler when at the Be the Better Broker thing with Jake. He was driving. We had to pull over so I could drive his car because his phone was just going off the hook nonstop, and he's answering everyone, calling the next person back. So that's your kind of prototypical how I want my account managers or sales team to be. So, and you take that where. Not to sound too negative, but when we were just building the team, I'd get LinkedIn messages from very seasoned BDMs just saying, "How much do you pay?"
Yeah.
Not even, "What's the product like? Can we have a discussion?"
Yeah.
Just, "How much do you pay?" Well, I'm probably not going to give too much time to those messages, and I'll rather focus on the people that there's a small group of them, but who take a lot of pride and want to make a difference, right? And credit to Jake and all of our sales staff. They knew it was going to be a tough road building the business, right? It wasn't going to be make your maximum amount of money from day one. It's let's build this thing. It's going to take a lot of effort, a lot of time, a lot of challenge, and then the money will follow. And I think they're starting to see that now. But I do like our sales team.
I think that goes to show, they obviously have a lot of trust in you and the leadership team as well, right? Because I think, if you had two potential job options, a startup is always, there's more risk, right? Where is this going to go for me? But it's also, if you can wrap your head around the opportunity, it's really cool to grow with the company, right? But really, it all comes down to leadership.
Well,
yeah, you talking to at the beginning, right?
I think it was when I first joined Bayview, I'll never forget my first day. It was just me in my home office and my fresh Bayview laptop. And I was like, okay, what do I do now? Right? How do we start building this thing? And, it was a little more in depth than that, but we built out the business plan. And then, as we got to the point of, getting kind of the board's approval on the budget to build the operation, then you start thinking about people. And you're like, okay, who do I know that I can call? And literally it just started organically. I was out at a conference and talking to someone, and I would have never thought they were interested. So then we brought them on, and then there's just a couple people after that. But you also have to learn quickly too. If someone's not working out for whatever reason, anything that we talked about today or whatever, you can't. And as you're starting up, you got to make the decision quickly. Yeah. You can't have, when you're, well, now we're 22 people or whatever, but back then if you're 7-8 people and someone's not working out, it just splinters the organization very quickly. And I always say this isn't for everybody,
Yeah, we've seen that toxic behavior start to wrinkle for sure. The one thing I just want to wrap on when it comes to this, the communication support piece is just broker feedback and how you handle that, and especially being a startup, that was obviously very important. I know like you would have got some slack on the 3 and 5 year term being the only options in the early days. How do you handle that broker feedback and then prioritize what to implement?
Yeah, like I think you gotta take out some of the dirty noise first, right? Because you're always gonna get some, oh, you guys suck, you haven't responded to my deal, but that's the person sending it in with refi to 80, bro, right?
Yeah.
So okay,
Yeah.
we'll park that one.
Yeah.
But no, I think brokers have been very good along the way with, where they think we needed to improve at various times, and part of that was in the turnaround time. But I think we're looking back, early days, we had all these new people in a new organization, like brand new organization, putting out our first couple deals. Everyone was a little nervous too, right? Like
Yeah.
everyone, rates are up, home prices were apparently going down at that time. So it's not like everyone was like, okay, let's just start throwing money out the door. It was like, whoa, okay, what are we doing on this, this deal in Sault Ste. Marie? Like, are we going to do it or not? And so I think, yeah, like the early days were kind of tough with that. But the broker feedback, I like brokers were actually great to us, I think, in giving honest feedback, but not being like abusive, right?
Yeah.
Like saying, okay, like, this happened on this deal. If you looked at it this way, it may have gone different. Okay, perfect. Or, there's a couple deals that slipped through the cracks, and if the broker wasn't calling us and banging their fist on the desk, we would have never known where those holes were. So yeah, I think wasn't even sure where I was going with that, but like the thing is I think we're getting to the point where now we have a broker advisory council. We're getting a lot of great feedback there, so we're just trying to implement it, but do it in a smart, efficient way, not everything at once, because that could also break the operation down as well.
Yeah, great feedback. Touching on training and resources for brokers. So obviously, it's an ever-changing industry. You guys are a newish lender. What was your approach to get in front of brokers, train them on your products and policies, and is that evolving as time goes on?
Yeah, we had a two-prong approach where, one was just the salespeople dialing for dollars and trying to get in front of people and just doing it in either small groups or larger group settings. And then we were bringing groups of 10 brokers into the office, just randomly selected some brokers we knew, to give them the lowdown. And actually those turned into not only educational sessions, but feedback sessions, right? Like I remember, one broker just said, look, just market these 3 things and you'll get the message out. You don't have to market that you do everything to everybody. These 3 things. And we started doing that, and we saw the business. We just got clearer with our message. Yeah. Because sometimes I do think in all the gray, the message can get a little muddied.
Yeah. What like when it comes to, like, let's say going back to your previous role in other companies, what's worked from building broker relationships, whether it's like your own events or training resources? Like I know education is becoming, a sought after topic for brokers when they're looking to connect with lenders and getting away from maybe, the alcohol induced type party scene, which, there's still a need for some of that, but we've definitely seen like the industry start to shift to more educational focused approach. Like what's worked in the past and what's working for you now in that regard?
Yeah, like I think, just a lot of one-on-one time, I think too, right? That seems like a lot of work, and it is. But what we like to do is start with group sessions, and then you'll naturally get some feedback from that broker group, and you can tell who's more interested or who may have more of your business type. So then you kind of focus down. I love this industry. I grew up in this industry. It's all I've ever known really in my adulthood. But I do think there's way too many events that we go to now that just don't have any kind of education tied to it, right? Like, people come by the booth and you have a chat and it's very high level, and then you leave with 50 business cards and you start calling the 50 business cards and you may connect with one of them, right? And then, I don't have the answer. I think we're just open to trying many different things to see what does work, and look for like outfits like you to tell us what you need, so we can come deliver it. Like, we'd much rather invest money on with someone who's telling us, look, we need this and we think this will work with your group. Okay, great. Like, we'll send people out to you, do whatever we need to do that education session. But paying for steaks and drinks before a deal's even funded never works.
No, unfortunately not.
Yeah,
Brokers love it though.
Yeah,
Yeah,
for sure.
yeah.
We love it too. I mean, sometimes, but yeah.
Everyone's looking for a free meal. Okay, so service standards, this is kind of where I wanted to wrap just on this segment. Like, maybe just explain the metrics, like the turnaround time and approval rates, used to maintain the high service quality.
Yeah, approval rates, we're at about a 25% apt to fund at the moment, which seems quite low, but I think it's probably better than I thought it would be at this point in time. Same day commitments on like pretty standard deals. The bigger ticket stuff does take a little longer. We want to spend a little more time on that. The commercial stuff, because we have the 3 business lines. We have the residential, small balance commercial, and now we've just launched our large balance commercial. So all of those come with like much different turnaround times. Resi's the easiest to turn around. Small balance next. It's basically residential on commercial property, and then large balance commercial take some time to get through.
I'm glad you brought commercial up. I had it in my notes to touch on, because that is a differentiator for Glasslake, the fact that you're focused on commercial, doing actually quite large commercial type loans as well. But where I feel there could be some maybe delays or disruption is just getting deals from brokers that never done a commercial file. And residential brokers are notorious for wanting to get into the commercial, segment of our business, and maybe just pumping the brakes on some of that stuff when it comes to, just inexperienced brokers trying to dabble in that. Like, what do you see there? And what's the best way for, a broker to even get involved in that space?
Yeah, I think it's a great space, and it's gonna, some asset classes have had challenges. Office mainly. I think we'll start to see that come back a little bit, but like my view with the brokers, you just got to market for it, and then you need the deal to learn the deal. Like, I think without having hands-on experience in a deal, it's hard to, like, for someone on my team to go in and educate them, because they don't have so it's kind of like, what comes first, right? The deal or the education? And it could be done hand in hand. But I think with small balance commercial specifically, I think people overthink it, right? It really is very similar to a residential underwrite, just on commercial property. So that's stuff we consider small, up to 5 million. Once you get over the 5 million, you go into the deeper analysis and go deeper into the cash flows and the net worth. But I think the small balance space is the easiest or the most efficient way to learn, because you have some forgiveness in there, because you can qualify the deal from a debt coverage perspective, or we have our own global debt coverage, or you can even go the TDS route.
Yeah, thanks for sharing that. And like, again, it's certainly a growing market, and we take the time to maybe pump the brakes on some of our agents trying to dabble into that, when, just given the complexity of it. But
I would think, I would throw this out, not to cut you off, but like, if that's an area your group wanted to get into, we could figure out a process that works early on. Like, there's been, we talk about getting on the phone with brokers and their client. We've done that on multiple small commercial deals, just because they're a little more complex. They're not too deep, but and I think it's just good for the broker to hear how we engage, the questions we ask, and then the next one will follow.
That's an education piece that I think is very much needed, and a great focus from like a lender's perspective, like you, to provide value to our team is training on that. And that's something we'll certainly, talk about offline. And it's been a focus with us. We have 4 designated commercial brokers within our office that's all they do. And, we just recently put together, a more structured referral process to connect our agents with those brokers, that then they can help them with those files and figure out what's, how to structure this file, where should it go. So that's going to be a big focus for us. Like, as much as we talk about the alt space growing so much, like there is a huge opportunity in this commercial arena. It's going to be a big focus for us going forward. So I'm glad you touched on that. Maybe just moving on and looking to wrap up a little bit here, just the future outlook, like, any trends that Glasslake is monitoring, and, we talked about the increased demand for small business, commercial, like where you see things going.
Well, we're keeping a close eye on performance. It's been good so far, but we chatted about that. But definitely, as you read various reports, delinquencies picking up. We kind of look at the NSFs as well, like not just true delinquency, but how many NSFs are coming through, because eventually that means money's tight. So where's that going to roll over? Values as well. Like, I think we're keeping a close eye on the major markets we focus in, because I don't think anyone has a clear view on where values are going today. And it's, you always have to think, if you're lending on a deal today at 70% loan to value, where's that going to be in 12 months?
Yeah.
Right? Are you going to be 68 or 75? Right? So it can go either way. But also, we're keeping a close eye on new competition coming in. Like, we get excited when new competition comes in, because it gets the message out about the segment of the industry more. And so, I think, I don't know, we're hearing of a couple of new ones coming in. I think that'll be pretty good. For the segment as a whole, because everyone should carry slightly different risk appetites, which means it's a more wholesome offering from a segment perspective back to the broker.
It's a great way to look at it. And we're aware of some of these other groups that are about to launch or just recently launched. But the one thing I find interesting is, like, nobody seems to want to dabble in the commercial space.
That's a fun, to me, that's a funding,
Okay.
That's a funding piece.
Yeah.
Commercial funding is much more difficult to come by. We just happen to have experience lending in small commercial and large commercial. The funding we pull on satisfies for res and commercial. So it was a natural fit. Like, when we started the business with small commercial first before residential. And I tell the story, like, in the first 2 weeks we launched, we had 200 million in applications. Wow. They were all garbage, right? Like, people were just waiting for us to launch, but it did show there was a demand, right? For the small balance side. But yeah, I think it's harder to get investors excited about the commercial space, because it's viewed as much more complex. And also there's capital adequacy requirements that certain investors would have to adhere to. So
yeah, I mean, I know a lot of brokers are starting to get more involved in the commercial space. I think historically a lot of brokers, I'm guessing, but probably 95% focus on prime and residential. And we're seeing a massive shift in that trend. And even a lot of brokers within our group are starting to get more involved in commercial, just because the conventional space has gotten so competitive, right? Mm-hmm. So I think that from a brokerage and lender to broker relationship, it's going to continue to grow.
Yeah. Yeah, we see it the same way. And we think, like, the small commercials are staple, and then the other two products are the add-ons that are becoming a staple as well.
Is there any advice for brokers that you'd want to put out there? Anything, like, I mean, we talk about diversifying, and just product knowledge is key, especially with this growing segment with alt and commercial now. Like, any advice for brokers that you'd want to state?
Yeah, I do agree with your point on, diversifying from a product perspective, but also my advice would be the leader in education. Like, go out and ask for the education. I think that does two things. One, you get more knowledge, but two, it signals to the lender that you're actually interested, and you may get a little more favorable treatment when you're proactively going out to get the education from the lender. So but I think there's a very, like, we were just talking about this on a panel last week as well. Education is lacking, I believe, in just the mortgage industry as a whole. So the more you can go out and separate yourself by being that, more highly educated, more knowledgeable in the segments that you operate in, I think it just separates you from the rest of the pack. And I think I do worry with, the limited education that we're one kind of like newspaper article away from a black mark on the industry. So if you can separate yourself from that, I think
I couldn't agree
that's
more.
a big thing.
Yeah, it's great advice.
So a pricing question. I know every alternative private lender has a range of pricing. You guys seem to have a very, very sharp lower end in your pricing range. How many applications are you seeing fit into that box? Is it pretty tough to achieve that floor rate?
No, no. No, the way I look at it is the way we built the business, thinking the portfolio was going to play out, it played out. So like average LTVs, like below 70, average FICOs over 700. So those ones would naturally get the premium rate. I think what was challenging though over the last 3-4 months is like rates were moving daily. So like we were trying not to move rates daily. You know what I mean? We were trying to just hang in there as long as we could. And but I think we're also getting a lot sharper on our pricing too, where like when we were first launching, again, I mentioned like everyone was a little nervous and anxious. Well, I think we were just like trying to hit the bullseye on the pricing each time and not pricing into the gray, right? Like you can't price a deal at 7% if that's going to increase the client's payment by $2,000 a month. Like that structure is never going to work, right? And it's a refi for a deck install. So you got to find. I would say this: it's about the nickels, dimes, and quarters, right? On your hairier deals, like where can you get the extra nickel, dime, and quarter, which then allows you to be much more aggressive on the very clean end of the stuff. And I think we're finally hitting a groove with that because it creates a bit of a tailwind, and then you can get really aggressive on the higher quality stuff. So today, I don't think I'm giving away too much, but like our average rate on new originations last month was just over 6. So if you look at like the delta between that and kind of where the federally regulated entities are, it's come in quite a bit.
Very close.
We have a little bit of a higher fee, but it's either 2% or 1.5% depending on the term you take.
Totally different offering though, right?
Yeah, completely.
Yeah. No, that's great feedback. Thank you.
Yeah, I mean, this has been great. I mean, that's pretty much a wrap for us. I mean, like we touched on some really good takeaways just around like the Glasslake focus, talking about the commercial piece, your approach to how to communicate and put yourself above, kind of the competition when it comes to communication and just being available. If you're a broker listening and have not dealt with Glasslake, I highly recommend you reach out. If you're a broker with a Better Way mortgage group, Jake Master is a great resource for us and somebody that's always available. I mean, at the end of the day, glasslake.ca is where we would, point you to reach out and look at, what Glasslake's all about. But, any final comments from your side? And
no, just thanks for having me.
Yeah.
And we look forward to partnering and I'll put Jake on notice. You threw his name out today, so his phone will be ringing. But I think, I just really appreciate the time and always enjoy talking to you too. So
Likewise, man.
Yeah, we really appreciate this. Thank you very much. And thanks for listening, everyone.
Thank you.
Awesome. Thank you for tuning in. If you found value in this show, please subscribe to our channel on your preferred platform. We're available on Spotify, Apple Podcasts, and YouTube. Your support is incredibly appreciated. We also welcome your reviews and feedback, which are crucial in helping us deliver outstanding educational content. Feel free to share your thoughts. A 5-star review would be fantastic if you think we earned it. Lastly, a vital announcement about Backpack Buddies, our chosen charity for 2025. This remarkable organization addresses a hidden hunger issue many are unaware of in British Columbia. While school districts provide meals during school hours, numerous children face food scarcity at home, particularly during the weekends. Backpack Buddies steps in to support these vulnerable children, ensuring they have easy-to-prepare, familiar food for weekends. This is achieved through collaborations with schools and an extensive distribution network. Your contribution can make a significant difference. With just $20, you can give a child in need a food bag from Backpack Buddies filled with enough meals and snacks to sustain them over the weekend and more. Once again, thank you for listening and see you on the next one.